What's going on, everybody? This is Matt Rinkey, the founder of Illumination Wealth. I'm very excited to be discussing a timely topic with one of my most trusted colleagues, Norman Mangina, who is a CFP and a senior advisor at Illumination Wealth. And so because of what's top of mind for most people beyond the election is that many people have to start thinking about their health insurance and their other employee benefit decisions that roll around this time of year. So Norman's our expert, our specialist in this topic, and so I thought we would have him on. So Norman, welcome.
Yeah, thanks, Matt. I definitely agree. Employee benefits and health insurance is a really important thing for people to understand and get right. It can be a really expensive line item in their budget. We've seen families paying health insurance premiums of $30,000 a year. So it can be a big expense, and there are definitely ways to save and to choose the right plan for you that's going to be cost effective. So
no, I know it is, and it's always changing, and it seems like premiums are always rising. It's just getting more and more expensive, and the cost of health insurance is growing faster than other people's incomes or other areas of which they spend. So yeah, it's a big thing to crack. And so I thought I'd ask a few questions and start on the health insurance side, because that's pretty much applicable to everybody.
Yeah.
Not everybody has employee benefits, and we can touch on some of those things at the end.
Sure.
But when people now either are going on the exchange and looking up their health insurance options, what are some of the key things that perhaps from a financial perspective that they should be thinking about as it comes to their health insurance decision that they're going to make?
Right. Well, I always say there's a financial component to every decision, and there's a personal component. And, before we get into the financial components, one of the things you really need to consider is the doctors that you're seeing currently. Yep. Can you see those same doctors on the health insurance plans that you're looking at? That's an important part of it. If you're not stuck on going to the same doctor, then yeah, you have more options. You can choose another plan that may be more financially beneficial for you. And so some of the financial factors you want to look at are definitely the deductible and the out-of-pocket maximum, right? The deductible is, what you pay out of pocket before the insurance company starts paying, and the out-of-pocket maximum is the most you'll pay in a year. So those are two important numbers to know. Beyond that, you want to understand the coinsurance and copayments. So coinsurance is typically a percentage of the cost that you pay, and the insurance company pays the rest. Copayments are what a lot of people are used to. It's spending $10 or $20 every time you go to the doctor. It's a flat dollar amount. And what a lot of people do is they wind up choosing the plan that has the lowest copayments. I only want to pay $10 when I go see the doctor. But what they also need to be looking at is the insurance premium. How much premium are you paying for that kind of benefit? Because the insurance company is not just going to give you that for free. They're not just going to give you the low copayment without charging you an appropriate premium. So when you're looking at insurance plans, you need to factor all those things in. How much is it going to cost you in premiums? What's your coinsurance or copayment? And what's the most you might have to pay under that plan?
Yeah, no, that's huge. I think a lot of people look to, how do we not have big out-of-pocket costs? But the premium is the only guaranteed out-of-pocket cost that you're going to have. And so that needs to be the focal point, I think, from starting the evaluation, not just what is my deductible going to be, or I have a big deductible, or I don't have a copay. It's the premium is the guaranteed cost. So
right.
Important to think about when you're, managing or making some of the, decisions that they're going to be making. And so, what do you see typically as the trade-off between, premium costs on a monthly basis or, out of pockets? Like, how do those things interplay with one another generally?
Yeah, so generally, the more you pay in premiums, the less you're going to pay in copayments and coinsurance. Usually the lower your deductible and out-of-pocket maximums are. So you're paying this large premium for the benefit of having lower out-of-pocket costs. And so there's a risk that you're having the insurance company take, right? But if you're willing to take on more of the risk, if you're generally a healthy person, don't have a lot of medical issues, you're probably better off choosing a plan that's got a lower premium, but has maybe has higher out-of-pocket costs, because it's likely that the savings that you're going to get from the premiums are going to outweigh maybe that extra cost that you have for co-payments or co-insurance or deductibles. It's typically what we see.
Yeah, and I really want to stress that point for everyone listening, is that many times the amount of out-of-pocket costs that you will have if you go to a higher deductible plan, if you're going to incur more out-of-pocket costs, don't amount to the amount that you will save by going with the lower premium plan. So your monthly premium costs that are going to save you money in comparison to an your additional out-of-pocket costs due to the higher deductible or higher copays. Now, that's not always true. And I think,
right,
some people might have health issues that might cause more frequent, doctor visits. Sometimes you might be preparing for a surgery, or that you're going to be having a child in the next year, so your costs are very likely going to be higher than a typical year. So you got to be mindful of what your health is and how things might change from year to year. But on average, that's really what we see. And so I think it's really important for people to be paying attention to those those trade-offs, as lower premiums might actually mean, all things said and done, more money in their pocket than higher premiums and less out-of-pocket costs. So
right.
And yeah, go ahead.
Yeah, I think this kind of leads into, when you're talking about these higher deductible plans, a lot of them today are HSA eligible, and HSA is a health savings account. And they're becoming more and more popular. One, because they typically come with lower premiums for the health insurance. The deductible, though, is higher. So we're talking about those higher deductible health plans. But they also allow you to save money in an HSA that you can use for medical costs now or in the future.
Yeah, that's really powerful. So to be eligible for an HSA, it is a high deductible health plan, an HDHP, another acronym, but it also has some other nuances than other high deductible health plans. It can't be a copay plan. So to be eligible for the health savings account option, it can't be a copayment, a plan with copayments. So
right,
it's just something for people to be aware of. They might have a high deductible plan, but they have copays, and that would preclude them from being able to utilize a health savings account.
Right. You, as the patient, has to pay out of pocket up to the deductible amount before the insurance company starts paying. So that's why a copayment doesn't work in this case, because you're paying $20, but the insurance company is paying $100 for the services, and so that's not eligible for HSA benefit. But
yeah, and
exactly.
So when we're seeing these plans, what we're seeing is the HSA eligible plans are significantly, in many cases, lower monthly costs than the gold, the silver, the high-end plans, which means, could be savings in the thousands and thousands of dollars per year. So that's one, kind of one thing to be aware of. But then there's the HSA cost, the HSA that you're talking about, that also provides benefits for people. Can you explain what those are?
Yeah. So the big benefit for the HSA is it is the only triple tax advantaged account out there, right? So when we think of what does that mean, triple tax advantage? So one, you make contributions to the HSA like you would make contributions to your 401k or IRA account. Those contributions are tax deductible. And unlike an IRA, there's no income limit that you have to be able to deduct those contributions. So anyone who has an HSA, no matter their income level, can deduct the contributions they make to the HSA in the current tax year. It's a huge benefit. Second tax advantage is that the money in the HSA account can then grow tax deferred or tax free. So as you can invest the money in the HSA account, just like you can invest in an IRA, and that money then, the earnings, the growth, capital gains that you earn on those investments is not taxed. That's the second tax advantage. The third tax advantage is you can take that money out of the HSA to pay for medical expenses, and you're not taxed on it then either. So this is money that you will never pay taxes on, and it's the only account out there like it. Usually with an IRA, you're going to pay taxes when you take it out in retirement. Or if you have a Roth IRA, you've already paid taxes on that money. But this is one of those accounts that's a really great wealth builder if an HSA plan works for you. So it's a fabulous account. If it works for you, definitely consider it.
Yeah, and I think it's great. And I think a couple other things. So for a family moving into 2021, a family can contribute if all our participants are in the HSA. If there's a family plan, you can contribute $7,200 to the HSA. So that's one thing. So that $7,200 that you contribute will then reduce your taxable income by $7,200. In California, there's not the same tax deduction, but other states do provide for the tax deduction. You still get it federally on your tax return, which is really good to be aware of. And the other thing that I think is what we encourage our clients to do if they're planning appropriately and they manage their cash, that this account is not spent. Many people get this health savings account and they put in money, and then they've got thousands of dollars in their checking and savings accounts. And then you look on their tax return and it says that they spent all of the money. They took distributions from all of the HSA that they put in for the year on their co-pays and deductibles and health insurance costs, right, which defeats that tax-free growth and benefit, which has significant value. $7,000, if that could double and triple over the next 20 years, you're avoiding capital gains, you're avoiding interest income, and don't use that debit card if you can afford not to. Don't use the HSA if you can afford not to. Keep your receipts, save them, put them online for the future. And then when you need the money, you can cash them out in the future tax-free. But let that wealth building component really grow for you, I think, is something that we would like to stress. Now, if people don't have cash in their bank, then yeah, being on this plan, you might be using it for your medical expenses. But if you park money outside, use your excess cash, use your saving, your monthly liquidity and to pay for your medical expenses if you can afford to. Mm-hmm. Can't. It's an emergency fund for medical expenses. So those are the things that we encourage. So I think in Norman and I's conversation and how we've evaluated these plans, in many cases in California, the health insurance marketplace is different from state to state. But in California, oftentimes we see thousands and thousands of dollars of tax savings for families choosing an HSA plan when you add up the premium savings, the tax savings, and the contributions. And what I also find interesting is that even in the scary high cost medical years, if you have a surgery, we see those plans, all expenses considered, being more costly than the out of pocket, than the low high deductible plans. So
right.
Like in both cases, you're better off high out of pocket or low out of pocket years. So it's yeah, you've seen that?
You have to run the numbers. You got to run some numbers and see what the true net cost is. Assuming you do have a high cost year, maybe there's a hospital visit or you're having a baby even. That it can seem like a scary thing to have to pay for all those costs up to the deductible and out-of-pocket maximum. But the cost savings on the premium and the tax savings on the HSA contributions, a lot of times works out better.
Yep. And yeah, and even the differentials in the co-insurance, like all those things make a
Right.
difference. So you got to do the math, because we're not talking 50
Yeah.
bucks. We're talking thousands and thousands of dollars for a family. That this is really important. So I
Right.
think we covered health insurance. If you have questions, please reach out to us about it. I know Norman or myself can absolutely help you figure out what you have going on. Now, beyond that,
Yeah.
anything related in the employee benefits world, because not only are business owners or individuals getting doing the health insurance, but a lot of companies are sending out, you got to enroll in your benefits between now and November 15th or December 1st. So what are some of the things that
Right.
people should be thinking about as as it relates to their benefit planning?
Yeah. So a lot of employers today, when you get your benefits package, you're offered a supplemental life insurance plan through your employer. It can be tempting to enroll in that, and it may be a good option if you're not in the best of health and you may have a hard time getting life insurance on your own. That may be something to consider. But for most, usually for healthy people, they're going to get better life insurance rates going to a reputable life insurance company and getting term life insurance on their own. Usually the costs are lower. The premiums are actually lower by going and getting it on your own. The premiums are fixed, meaning they don't go up every year. And so you can lock in a really low life insurance rate, at your current age by going out and getting it on your own. Whereas in the company provided life insurance plans, typically the premiums go up as you get older, and they can go up significantly, double, triple what you're paying now. So if you're healthy, we'd recommend considering getting a life insurance policy on your own outside of the company. So that's one thing that we see a lot. Another benefit a lot of employers are offering these days is a legal benefit. And essentially that allows you access to an attorney for various kinds of legal issues that come up in your life. One of the things that we typically recommend to our clients is, if you have a legal benefit option and you don't have your estate planning done, this is a really low cost way to get that done. A lot of times we see legal benefit premiums of around $8 to $15 a month through the payroll deductions. And, that's a couple $100 for the year. Whereas if you go to an attorney to get your estate planning done, maybe $2,000 to $3,000. So huge savings you can get by enrolling in your legal benefit and having your estate planning done if you haven't done it yet. That's a good one.
Absolutely. Absolutely. And that would mean getting a revocable living trust, getting your wills, getting your powers of attorney, for healthcare and financial
Right.
things that you put off, but perhaps by enrolling in that legal benefit, it'll, compel you to get that complete. Because once the next
Yeah.
enrollment period goes around and you got your estate planning done, you don't need to enroll again and stop paying that $8 to $15. So it's
Right.
that could save you thousands of dollars. So I think it's a great thing, and really put in some valuable documents and planning for your own family and legacy.
Yeah, definitely. Another benefit a lot of employers offer is a long-term disability plan. These company provided plans aren't as strong as a plan that you can get on your own in the private market. However, they are very cost effective. And so you can get a good, decent disability, long-term disability policy through your company at a relatively low cost. One thing that we would recommend, a little tweak, if you will, to the plan, some employers allow you to pay for those premiums with after-tax dollars. So you have the option sometimes to do pre-tax, which means it's not what you pay you don't pay any tax on it, or you do it after tax. So if you do the long-term disability after tax, the benefit of that is if you do become disabled and you're getting a monthly benefit payment, that monthly benefit payment is not taxable. Huge. So if you're getting a $3,000 monthly benefit from your disability insurance and you're having to pay taxes on that, you could be paying 20-30% of that is going to go to taxes. Whereas if you did choose the after-tax long-term disability premium payment, then you're not paying taxes on that $3,000 monthly income, and it's all yours. So that one little choice that you have can make a big difference. Some employers offer discounts. They've negotiated discounts with wireless carriers or computer suppliers or office suppliers. Check to see if your company has negotiated discounts that you could be eligible for to save money. Another one would be some companies, public companies, offer an employee stock purchase plan where if you buy into the company through the stock purchase plan, they may give you a discount on the stock, or they may contribute additional money on your behalf to buy more stock. That could be a great thing to consider if you have some extra money to invest. So definitely look through your benefits package. Consider the benefits that are out there. There are definitely some good benefits to take advantage of.
Yeah, and so I think to summarize, like there's things out there that could save you lots of money, protect yourself even further. And, there's things that in those packages that can help you build wealth, where it's the employee stock purchase plan and buying things at a discount, but you should also have a plan around when you will sell and how you realize that versus just putting money at risk. So there's planning to be done, and it's not just about what you enroll in, it's what you don't enroll in, because we also see people enrolling in things that are just a waste of money that don't really add any value. And so, it's important that you revisit things from year to year, right? And understand, well, each year, does this still make sense for me? And how do I not waste money on benefits that aren't really valuable for yourself? So great overview, Norman. Really appreciate it. I know this is an important time and important financially for people. So I know you're available, Norman at illuminationwealth.com to help people out, and I'm sure we'll be back with more tips and insights on how to make the best of your financial life going forward. Thanks, Norman.
Yeah, absolutely. Thanks, Matt.
Yeah, we'll do it again soon.
All right.
All right, take care.
Have a good one.